Hello, this is Jamie Ward, Head of Investment Solutions for AJ Bell Investments. This is the Q3 2022 update for the AJ Bell Managed Portfolio Service. So it should be familiar to many people who have watched it by now, but we're going to run through a fairly familiar set of contents, talk a little bit about what we do, just as a bit of a reminder. Some people might not necessarily know the full scope of what we do. Then I'm going to sort of talk a little bit about performance, review of markets in Q3 and actually in the context of Q3 and the whole year. Just talk a little bit about how that's affected the different types of portfolio. And then I'm going to touch a little bit on the UK economy, because there's quite a lot about the UK economy in the news at the moment. I think it's quite important to provide a little bit of perspective. And then I'll just kind of summarize what we've talked about. So we run two basic sort of buckets of portfolios. We have a growth range and an income range. The growth range is the largest of the two, so I'll talk about that one first. And these are the thing to know about these are actively managed risk targeted portfolios. So we start off with Dynamic Planner's DT scale for our risk targeting. We take the middle 6 risk profiles, which are DTs 3 to DT8, and then we build up our MPSs. So DT3 would be MPS 1 all the way through DT8 being MPS 6. They're implementing these different types of risk bucket. So firstly, we have the passive MPS, which is our most cost-effective way of doing things. Runs around 28 basis points on the OCF. We have something that we refer to as the Pactive MPS, which blends active and passive together to give a combination of the potential for alpha in the active, but the cost effectiveness of passive. Then we have a full active MPS, where the entirety of the range is made up of active managers. And then finally, we have a responsible MPS. So this is for those sorts of clients who wish to have a responsible overlay to their investments. And again, just like with the passive, Pactive and active, this runs right through the risk range MPS 1 to MPS 6. And for those that are interested, we also have a growth fund range, which is very, very similar to the passive MPS, but in the form of a fund. So that means we've got 5 different ways of implementing and 6 different risk profiles, which makes 30 actively managed growth portfolios. And on top of that, we also have 1 responsible growth fund. On the income side, we have income and growth. The income, quite unsurprisingly, targets income. The income and growth wants income and a little bit of growth. So you tend to get a slightly lower with a little bit of growth in there. With this one, we have 3 different ways of implementing. Firstly, we have passive MPS implementation. We don't run a passive MPS on this one, but we do have an active MPS for the income. And then finally, we have 2 income funds, which are very similar to the passive MPS. So that's 3 implementations on 2 income profiles to make a total of 6, making 37 in total. The most important for this presentation is the 28 MPS portfolios we run. So let's talk a little bit about performance. So starting on the MPS performance for the passive range. So these are actively managed, but they are passively implemented. And these are the ones we've got 5 years of performance on now, because we launched with these passives. The main thing to note really is it's the third quarter of 2022 has not been unlike the last year. That is to say, in this kind of environment, which is a pretty unpleasant investment market, the lower risk end of things has underperformed the higher risk. And the reason for that is the lower risk is heavily into fixed income securities, because that's where there's a much lower amount of volatility, whereas the higher risk is in equity. But equities have outperformed bonds this year. So as you can see on the 3 month there, the passive MPS 1 is actually the worst performer, down 1.2%, and the best performer is actually the passive MPS 5, which is 1% up. What I would say about this is, and whilst we don't have the benchmark on there, disappointing though it is to lose money in a portfolio, particularly a low risk one, these numbers represent considerably better than the benchmark. And the reason for that is because we take a slightly more active approach to our risk management, which allows us to lower what we refer to as idiosyncratic risk in the portfolios. And how that's manifested in the lower risk portfolios, the MPS 1, 2, and to a certain extent 3, is by going lower duration on the bond portfolio. Now, lower duration basically means securities that are less susceptible to interest rate rises like we've had this year. On the active range, it's a similar sort of a story, but the thing to note here is that active is once again underperformed passive. We've really found in the last year that this hasn't been a great environment for adding alpha in the active funds. And once you include the cost of having an active manager in there, they really are struggling to keep up. And as you probably expect, the Pactive performance is some blend, some halfway point between the Pactive and the active and the passive. So let's talk a little bit about the drivers of performance in the last year. So this is our active versus passive barometer, so to give us an idea of what might be driving what's going on here. And typically, if one of the dials is on the red side, it should be favouring active investing. If it's on the green side, it's typically the passive investing. But what quite unusually in this market, we've had a very weak market. There's been very little direction in equities, particularly in the last 3 months. So there has been very little in the way of a lead from either growth, although there is some dispersion now, which we'll talk about in a later slide. In the fixed income market, high yield has done better than government bonds, and also in equities, marginally the smaller cap equities have outperformed the larger cap equities. Now, this is unusual because we've basically had what you might refer to as a risk-off environment where investing is very, very difficult. Now, active investors, not in totality, but on the whole, will typically favour value equities, higher yield in the bond portfolios, and smaller cap. And what you can see over 3 months, there has been very little in the actual equity direction, but on the fixed income direction, it's very much the high yield that has done best. And in the on the 1 year view, which is those three at the bottom, all three are pointing towards this being a good environment for active. But the reality is it hasn't been the case. So it's been very unusual in this market that it should be favouring active investment and actually is favouring passive investment. Talking about some of the other market barometer drivers in the last year and indeed the last 3 months, the big story to note on here is the dollar. So, and those top three dials, the one on the top left there is showing that the pound has fallen by almost 10% against the dollar in the last 3 months, which is pretty extraordinary as a move. And over the last year, it's down around 20%. What you'll see a lot in the news, particularly in the UK, is we'll be talking about the UK economy and sort of the weakness of the pound. But as we'll talk a little bit later on in the presentation, we think there's probably a little bit more to it than this, and we need to be a little bit more nuanced about this. The other things to note is short duration continues to do much better than long duration, and that's because we've had a generalized weak market for fixed income. Now, what hasn't happened here, and what you might have expected to happen, is a steepening of the yield curve. So that would be showing, the reason that this would be showing that short duration is outperforming long duration might be because long duration yields are rising faster than short duration. That actually isn't the case here. There's a parallel to actually a very slight shallowing of the yield curve. So the actual interest rate moves on the shorter duration end of the fixed income curve is actually larger than on the longer end. And that it might imply that we're facing something like the beginning of an inversion in the yield curve, which some believe is a harbinger of a recession, which wouldn't be on the realms of possibility given what's going on in the economy at the moment. And then finally, the last thing to notice on this slide, that top right chart there, that equities have massively outperformed bonds in the last 3 months. So we've had a risk-off environment, but it's only been risk-off in bonds. It's very, very unusual. So as a bit of an overview of what all that means is geopolitics remains very, very fraught. We're all fully aware by now of the Russian invasion of the Ukraine and what that's doing to supply chains, but also what it's doing to allegiances. You know, which way is China going to go on this? Which way is India going to go on this? And it creates a great deal of uncertainty in global markets. There has been a considerable convergence in bond equity valuations. So one of the stories for probably the last 10 years now is that bonds have looked very expensive compared to equities. This is something referred to as the equity risk premium. there was always the danger, and it was inbuilt within our risk parameters, that equity risk premium would compress, i.e. there'll be a convergence in those valuations. And the way that was most likely to happen was bonds would get cheaper. And that's what's happened this year. Overall, we would say that this is an acceleration of existing trends. So a lot of what had been going on in this year, which seems to have been accelerated following the Russian invasion of Ukraine, these undercurrents were already there. It's just that the Russian invasion of Ukraine has sort of exposed it. And finally, this basically leads us to a period of quite heightened economic and indeed market volatility, because of uncertainty creates volatility. So talking a little bit about the equity markets, there's been a partial reversal in what has been driving things. So the two charts to notice to start here is on the right hand side, you've got the equity factor performance over the last quarter and the equity factor performance over the last 12 months. Now over the last 12 months, notice that the big drivers are the sort of high dividend yield, value, low volatility, the kind of old world economy stocks, your energy companies, that kind of thing. But in the last 3 months, the drivers have been the exact opposite. Overall, for the year, the best place to have been is in those high yield, value, low volatility areas. But just in the last 3 months, there appears to have been a slight reversal. Not total, but slight. And you can sort of see why it's not total on the left-hand side, where we've got these equity sector performances over the last quarter and the last 12 months. Now note that the energy sector over 3 months and 12 months is the best performer. And indeed, communication services is the worst performance on both the last 12 months and the last 3 months. Communication services being basically things like Facebook. But then notice when you go in from the extreme slightly, things like the consumer cyclicals, second best performer over the last quarter, second worst performer on the last 12 months. And this is why we've got this slight odd divergence whereby growth has apparently reversed to a degree over the last 12 months, but not in total, because there is a lot of dispersion amongst the sectors about what's leading what. In the bond markets, frankly, we can't think of a better word other than miserable. But there is some unusual things to note here. The main one being, this has been a very, very difficult market for fixed income. And what you usually see in a difficult market for fixed income is the lower the quality, i.e. the higher the yield of bond, the worse they perform. And the reason for that is the sort of higher quality end, your government bonds, they will fall quite a bit. But then because they're falling, that's a risk-off environment, the higher risk things like high yield and emerging markets do even worse. The exact opposites happened this year, well, particularly in the last 3 months, whereby government bonds have underperformed quite badly compared to higher yield. So this is unusual because it means that the premium you receive for holding what is a demonstrably lower quality bond has diminished at the exact time when risk appears to be heightened. We could speculate as the exact reasons for that, but it could be that there has been mild panic in the bond market, and during periods like that, markets cease being a weighing machine in the sense that they stop weighing up the pros and cons and to come up with a logical valuation for different assets and become cash machines. And what that means is people just want money out of the fixed income market, so they sell whatever's the most liquid, and the most liquid tends to be the lower risk end. What that could mean is it's a harbinger for underperformance of the lower quality compared to the higher quality. Now that doesn't necessarily mean the lower quality does well, it could, or the higher quality does badly. It just means outperformance probably in the government end of the fixed income market. So we've already mentioned slightly currency. So this is currency for the last quarter, not the last 12 months, just the last quarter. And you can really see the big decline in the sterling against the dollar on this one, which is getting up there towards 10% at 8.8%. The thing to notice is the dollar very much stands out on there, and in fact, sterling is even slightly outperformed a couple of minor currencies in this period. And you wouldn't necessarily say a 2% decline against, say, the euro would be beyond the realms of normality. It is something that would happen in a single quarter. So I'm going to talk a little bit about the UK economy. I'll start off talking about what the narrative to us appears to be, and then talk about the reality of things. And that will feed back into that point about the UK sterling, the UK pound. So these are some of the headlines that I've taken from the last week from very reputable places. So UK in turmoil as government gambles to solve economic woes, fuel crisis instead. British pound hit record low after tax cuts spark concern about the economy. My favourite of them, which comes from the London School of Economics, has the UK become an emerging market, which I'd say is a pretty absurd decision, absurd position to take. The UK government's plan is both bad economics and the lost opportunities from the FT, and those two at the bottom there are from major US outlets. So the narrative is the UK economy is in a bad position, and you get the impression from reading these headlines, a uniquely bad position. But let's talk about the UK economy, but add a little bit of perspective. So the UK economy is poor on an absolute basis. Our current account balance is poor and has been for a very long period of time. Inflation is high, debt is high, and so is the deficit, i.e. debt is growing. But the UK current account balance is poor, as in its 19th out of 20 in the G20. Incidentally, the 20th out of 20 is the US, which is a very large part of it. And whilst it is a deficit, it's one of about 6 economies that actually is in deficit on a current account balance. Inflation is running high, but it's below the US, and it's very similar to the EU. Debt is high, but considerably below the US. So debt is currently running around 96%, and this is I'm giving this presentation in October 2022. Debt is roughly 96% of GDP in the UK. In the US, it's about 140%, and the EU as a whole is about 96%. So very much in line with the EU. And the deficit is not as great as an economy like the US. So therefore, the debt pile is actually growing slower than places like the US, which have already got a worse debt pile. So the sort of conclusion about the perspective here is, yes, the UK economy is in a poor position on an absolute basis. Unfortunately, the UK economy is also just sadly typical of a lot of the G20. So let's talk about the crashing pound. I've seen a lot about this. So BBC, British pound hits record low after tax cuts spark concern about economy. And then you can see that the pound is down a lot. It's down almost 20% against the dollar over 1 year. But the euro is down 16% against the dollar, and the Japanese yen is down almost 30% against the dollar. This means that the sterling is actually up against the euro, up against the Japanese yen, and very, very similar actually to the euro. It's not a crashing pound. Probably the real news story here is a soaring value of the dollar. But sometimes in the UK, we can be a little bit parochial and we just look at what's happening to the UK economy. We look at the sterling, we look at the UK stock market, and we stop considering the global perspective. And the global perspective is actually what's happening is there is a flight to safety towards the US, and that's causing a spike in the US dollar. So sterling is weak, yes, to a degree, but the real story is the strength of the US dollar. Now, there's been talk about the IMF because they made a warning about one of the tax cuts, which actually got reversed. And people in the UK tend to have dim memories of the IMF because in 1975, the UK economy had to be bailed out by the IMF. That again in the press. As I said, the real story is about the US dollar. Now, in 1985, 10 years after the UK went to the IMF, US dollar was very, very strong, and there was something called the Plaza Accord. Now, to us right now, the UK economy is looking more like 1985 than 1975 in a global perspective. That is, the main challenge that the global economy is dealing with right now is a strong. So the market outlook, it's a little bit of a cop-out, but the market outlook is very unpredictable. And it's unpredictable because there's very large idiosyncratic risks out there, like what happens next in Russia and Ukraine, that just simply can't be predicted. We can't calculate what's going to happen there. And as a result of that, it's become very, very difficult to determine the true rate of inflation. Now, the oil price spiked quite high early in 2022. And there has been a bit of a collapse in supply chains, which made it very, very difficult to get hold of certain goods. And that has caused a spike in the value of certain goods. Now, we would argue those sorts of spikes are from or what's called transitory. So you wouldn't expect necessarily the price of natural gas to go up 200% every single year, because that seems unrealistic. We believe there is underlying inflation, and that inflation is probably higher than it has been for quite a long time. But to actually determine the true number is quite difficult. So the point about it is not to get overly concerned by a number of say 9.9% as it is as of the day I'm speaking, but just know that inflation is a problem, and the solution to that problem, unfortunately, is going to be higher interest rates. The UK is poor. We're spending too much money. We have a trade deficit. But the fiscal situations all around the world, particularly in the G20, particularly in the West, are not great either. What's been going on in the last year has been a closing of the equity risk premium, or that ERP, and it'll be very interesting to see how that plays out, whether the equity risk premium remains back to this compressed level or whether it expands out again. And if it expands out again, how that happens. There's two ways effectively you can expand a equity risk premium. You can either go into an equity bear market or a bond bull market. And the one last thing I'd say about market outlook is, whilst it's definitely unpredictable, buying bonds this year is a considerable improvement on buying last year. This time last year, so October 2021, you would get about 1% for investing in the UK 10-year gilt. As of I'm speaking right now, you'll get 4.3%. That has to be more attractive than it used to be, and therefore bonds are becoming a more attractive investment. If you want to keep up to date with AJ Bell Investments, there's plenty of information on the AJ Bell Invest Centre website and all the usual reports. But for this quarter, I will speak to you next quarter.